been a while since we talked about gloves, and we're going to have a special focus on Hartalega this round. Hartalega is a company that we always consider the best among the four in terms of just all round, right? However, year to date, it's looking quite bad actually for gloves. And initially, we thought with tariffs and things like that, we would expect more positivity because China will not be getting more orders, especially from the West. And, at the very least, the big four in Malaysia can maintain some market share. So why is it down so much? And if my eyes are correct, they are down the most among all, right?
Yeah, correct. It's about like 70%,
60,
69% or 70%, you can call it. Then the rest is all pretty much similar.
And this is year-to-date numbers for those who cannot see.
Yep, exactly. So we're going to dive deep on why they are dropping, and it has to do with their latest quarterlies. But before that, we want to look at some of their metrics. So number one, which is the valuations. While we're not going to be looking at the price to earnings because their currently is quite, I would say, not so significant. At the moment, they are not really making much of a profit. So we're going to be looking at the price to book and also their NTA or tangible book value. So you can see that this blue color line is actually their price to book value. And before the oversupply situation, they were actually trading at quite a premium in terms of price to book. It's always about like 5 times. But right now, we're actually going back down to all the way down to 0.94 times, which is a rare sight to see. And this only happens when China decided to come into the playing field. Then you can see that their NTA also has started to like fallen after 2022.
So there are write-downs, things like that, right?
Yeah, exactly. So whether this will be an undervalued situation, we're going to be talking about that at the end of this video. And you also can see some of these numbers, right? Right now, it's not doing so well. Sales is back. You can see the amount is back to pre-pandemic times. It's about 2.6 billion. But if you look at the profitability or the margins specifically, it's actually not recovering yet. It's falling, down the cliff. Last time they can do like 15 to 18% net margin. Right now, it's about 2% only. And why is because it has to do with their cost of production.
Mm-hmm.
So this is actually depicted from the edge. You can see this is how is the cost structure for the Malaysian glove players. So about 40 to 50% is related to raw material, and specifically for nitrile glove, we are looking at this rubber, which is the NBR or nitrile butadiene rubber. So you can see that over time, prices of these NBR has gone up. So that's why their cost of production also has been going up. But if let's say these prices start to fall, then maybe their cost of production will start to like decrease a little bit. And also you need to see whether this is assuming whether it affects their ASP or not, their average selling prices for the 1,000 pieces of products that they produce. But yeah, so that's a huge chunk which is coming from raw mat. Then the second one, which is the fuel cost. So fuel, obviously right now the Malaysian or the Southeast Asian glove manufacturer, they all rely much on the natural gas, whereas for China, they are using coal. So that's why, they are more cost efficient in that energy space. So that's why you can see that China's glove makers like Inco or Blue Seal, their margins are still pretty much healthy. It's because of these energy costs.
Mm-hmm.
And then there's also like labor, electricity, and also water
costs. So
costs.
basically, the thing I'm getting from this is that it's an advantage that Malaysia cannot really overcome, right? Because we can't switch suddenly to using coal. At least I don't think the big players are going to do that.
Yep, exactly. So that is the disadvantage that we are having right now. But there's like a strategy for Hartalega, which they are trying to do to actually mitigate one of the costs in one of these cost structure. We're going to be talking about that in the later slide. And this is the latest results. You can see that sales volume actually dropped 3.3% if you compare with the last quarter. So far, things are still pretty bad. Previously, we are kind of expecting them to go back to normalize, sales volume and utilization rate about 70%, 80%. But right now, it's like back down to like 67 to 69%. So it's still not so good. And if you look at Sri Trang, because Sri Trang also recently just announced their latest quarterlies, you can see that.
For those who don't, this is the Thailand.
Yeah, the Thailand's glove manufacturer. So you can see that their volume was down 1.1% compared to last quarter. But their ASP is actually down negative 8%. So you can see that there's a difference. Like here is like negative 1.1% in terms of volume, but this one is negative 3.3. But for Sri Trans, their ASP actually dropped even more. So this tells us that maybe Hartalega maintained their average selling prices, which resulted them to actually lost more in terms of sales volume
Right.
for this particular quarter. Whereas Suitrang, they are still willing to like throw prices, like and
Well, this is commodity business, right? This is in real life, actual numbers, commodity business.
Yep, exactly. And you can see that analysts, everyone is still pretty much bearish, except for Kenanga. Kenanga is not here. But if you look at their opinion in terms of target prices, they think that Hartalega is worth about 3 ringgit and 10 cents. So they are kind of like doing like a JP Morgan when the glove industry was very bullish. So JP Morgan,
Yes.
if you guys remember, right, they were the only guy who is very bearish. Then this one is when during times of the mega bearish, Kenanga
What
is
was
the
the
one who
thinking
bullish.
behind that? Why do people feel? Why does Kananga think that it can reach like more than double, right?
Yes, correct. So it's basically eventuality kind of like things that is going to happen. So it's like right now we are facing a lot of max pain, but sooner or later the demand will kind of like slowly outstrip the supply.
And they are thinking that it can go back to not during pandemic, but pre-pandemic numbers.
Yes, correct. Something like
Yeah.
that's their target lah. And also China, the reason why China is doing so well is because they are getting financial support from the government.
Yes, yes.
Then the subsidy with the coal. So let's say, and also on top of that, you have like tariff against from the US. So assuming like all of these pains like start to like kick in, then they think that Malaysian glove makers will have an edge. Not to mention the reason why the current sell off has been like going down so badly is because of Quap has been actively selling their stakes recently. So yeah, what is actually different right now is Hartalega is trying to manage their labor costs. So if you remember the cost structure breakdown, right, one of the key components also is related to labor. And they are doing a lot of automation. And so you can see that their number of headcounts is going to be reducing by 2%. And they say that this will actually help to improve manufacturing costs by 7%. So far, they are still trying to consistently try to find ways to actually be more cost efficient, sell all the machines that it's old and underutilized, and maximize whichever machine that is can produce or yield the best production output. And then they also got say the prospects, our demand for global demand for gloves is actually back to pre-pandemic level already. So you can
Yes.
see that last time it's like 336 billion, right now it's 370 billion. And not to mention, the fourth quarter of 2024, the US buyer already has started to deplete their excess stock. Cause if you guys remember, there was a front loading and there's like overstocking from the buyers because they thought that tariff is going to be more costly. So right now that stock has actually started to deplete, and then they expect there's some sort of recovery coming in the fourth quarter or maybe even next year. So and also they say that structural demand for rubber gloves will be projected to record a healthy CAGR of 7 to 9%.
But of course, the big learning lesson here is that if you take a step back, right, and you look at how demand has pretty much returned, but sales have pretty much dropped. So the only explanation is that the prices have gone down
Yes,
crazy.
so there's
right?
still like an oversupply situation.
Yeah.
They are
and,
trying.
and it has also gone down faster than the cost has gone up. So
Yep.
that explains the margin compression as well. So it seems like the China situation is not going away. And I think based on the numbers here, because demand has pretty much picked up. I mean, leave aside that there is stockpiling and there's a return. If you just do the math, if 289 to 370, that's quite a significant jump, right? That's more than 10%, that's 10-15%. Even then, you see the numbers for Hartalega, especially profits, are actually going down a lot. So what it means is, I think where I differ a bit with Kananga is that they need to factor in the China side a lot more, because the tariffs have been there since years ago. And that did not stop the profits from
So
dropping.
the tariff, that one is just a small little short term kind of like
There you go.
catalyst boost,
Yeah,
but
exactly.
the long term is more on the demand side of glove consumption would eventually outpace the supply production for all the globally, even though we're in the excess capacity. It's just going to be like an eventuality kind of thing that is going to
Correct.
happen, but it's going to take like don't know how many
I
years.
would say the answer to where the so-called target price and numbers are is in between the average of pre-pandemic and today.
Yeah.
So it's somewhere in between there. I don't think it can hit pre-pandemic.
Yep, exactly.
But hey, happy to be proven wrong.
Yep. So the final thoughts over here, on top of like a lot of cost of production, they also getting hit 101 million tax by Uncle Sam. They say that they didn't pay certain tax from 2017 to 2022. So all these actually feel even more negativity in this company. Then also on top of that, you have electricity costs, which is going to be increasing for most of us, and also fuel costs. I mean, if you can recall, the government actually removed the subsidy for that, so that also increases their costs. And when will they recover? So you can see that this is actually a chart that was shared during January 2025. You can see that right now the global supply, at least the projection, is around like 500, and then it's growing to about 600 billion pieces of glove. It is still far outstrip the demand. So you can see demand is still hovering around 450 to 526 billion. So which means that for the next few more years, there's still going to be an oversupply situation. So probably 2028, maybe 2029, we shall see whether demand will maybe start to outstrip supply. And the final question that most of you guys may be asking is whether is it a buy for today's current price? I mean, because it looks pretty much attractive, right? It's at its all-time low. So I think that obviously there will be bias when things are max pessimism, right? When there's like no more like positive thing to talk about this company, there may be some sort of like bargaining opportunity for current price point. But the flip side is that you also need to know when can they recover. So that is actually the $1 million question that you need to know, because it could take like years, right? It could take not 1, 2, maybe 3 or 4 years. So you need to see what is your holding period for this particular company. And on top of that, you also need to know what is the opportunity cost. Would there be a better company than Hartalega at this current price, right? So that is our thoughts about this. We will leave it to your own judgment. And you have any final thoughts?
No, I just think that where I sit is I'm not as bullish as Kenanga, but certainly the price now seems, as John said, max pessimism. So your answer again is in between here and Kenanga.
And yeah, so just before you guys go, we have a 30% off for FIRL Pro. So for those who actually attended our last webinar, you guys have a quick discount. And also it's now open until the 18th of August 2025. So if you want to get instead of 10%, you can have a 30% off right now, and the links will be in the description and comments. And what is FIRL Pro? Is where we actually share our analysis on companies that we find interesting, and some of the companies we do initiate in our model portfolio. So we have 3: Malaysia, Boring, and also Global. So as the name suggested, the Malaysia one is focusing more on Malaysian stocks. Boring is focusing more on Malaysian dividend-paying company. The Global is focusing on every single country except for Malaysia. And so far, I mean, the results has been pretty well. They're pretty good. And if you want to know what are the companies that is initiated in the Boring portfolio, if let's say you are a dividend lover, you like cash flow, you can check it out there. The dividend yield right now is about 6.71%, which is higher than EPF's 6.3%. And if you want to get a taste, you want to see how we do our write-ups, we also have a free sample for you. And we just to share with you guys, we have 2 reports. One is KGB. KGB, if you guys see the share price, actually have been doing pretty well already. And another one, which is Delium. So Delium, this is the only company that we actually sold from our free sample. And if you want to see how we do our write-ups, and on top of that, how we do our management notes, and also some of the videos about SIB, it's also inside this free sample. The links also will be in the description and comments. And that's about it for today's video. See you guys in the next one.
Bye.